Today, you will learn about different types of mortgages in Canada. If you are buying a home in Canada and you think a mortgage is just fixed or variable, you are missing most of the picture. There are actually multiple types of mortgages in Canada. Choosing the wrong one could cost you tens of thousands of dollars over time. In this video, I am breaking down fixed versus variable, open versus closed, insured versus uninsured, high ratios versus conventional, HELOC, reverse mortgages, construction mortgages, private lending, and specialty options most people don't even know exist. By the end of this video, you will understand exactly which mortgage structures make sense for your situation. Let's start with the most common type, the fixed rate mortgage. With the fixed rate mortgage, your interest rate stays the same entire time. Your payment stays the same. Your budgeting stays predictable. Most Canadians can choose either 5-year or 3-year term. You can choose shorter or longer terms. For example, if your rate is 4.99%, it remains 4.99% for the entire term. This option is the best for first-time buyers, families, or anyone who values stability and doesn't want surprises. The downside is that if rates drop, you don't automatically get benefits. To take advantage of lower rates, you would need to refinance, and that could trigger penalties. Now, let's talk about variable mortgages. A variable mortgage moves with the Bank of Canada's overnight rate. When Bank of Canada raises rates, your mortgage rates increases. When Bank of Canada cuts rates, your mortgage rate decreases. There are two main versions. The first is an adjustable payment variable, where your payments changes when rates changes. The second is fixed rate variable, where your payment stays the same, but more of your payment goes toward interest when rates rises. Variable mortgages are often chosen by investors or buyers who believe rates will fall. Historically, variable rates have often outperformed fixed rates over a long period of time. But short-term uncertainties can be stressful if rates spike quickly, like we have seen in the past. Next is open versus closed mortgages. This has nothing to do with whether your rate is fixed or variable. A closed mortgage typically offers a lower rate, but comes with penalties if you break the term early. An open mortgage has a higher interest rate, but allows you to pay it off with some months of penalties. Open mortgages are usually used for short-term situations, such as if you have planned to sell your mortgage within a few months, or expect a large lump sum of money soon. Now, let's discuss high ratio versus conventional mortgages. This is based on your down payment. A high ratio mortgage means you are putting less than 20% down. Home buyers can now purchase properties valued up to 1.5 million with less than 20% down. In Canada, that requires mortgage default insurance through providers like CMHC, Sabin, or Canada Guarantee. The insurance premium is added to your mortgage amount. Now let's talk about conventional mortgage. A conventional mortgage means you are putting 20% or more down payment and do not require mortgage insurance. Interestingly, high ratio mortgages sometimes receive slightly better rates because they are insured and therefore less risky for lenders. Closely related is insured versus uninsured mortgages. Insured mortgages are those with less than 20% down and backed by default insurance. Uninsured mortgages have 20% or more down and are not backed by insurance. Rate prices and qualification rules can differ between the two. In some cases, insured mortgages qualify for better rates, even though borrower has put less money down. Let's talk about HELOC, or home equity line of credit. HELOC is not a traditional mortgage but is tied to your home equity. It allows you to borrow against the value of your home and only pay interest on the amount you use. As you pay it back, the credit becomes available again. It's just like a line of credit, but it's tied to your equity. Home equity line of credit are commonly used for renovations, investments, emergency funds, or business purposes. Rates are usually variable. Many Canadians use a re-advanced mortgages, which combines a traditional mortgage and a HELOC into one product that grows as you pay down your principal. Another option is reverse mortgage. This is available to homeowner aged 55 and older. A reverse mortgage allows you to access your home equity without selling your property and without making monthly payments. The loan is repaid when you sell the home or pass away. It can provide cash flow for retirees, but interest compounds over time, which reduces the value of the estate left to heirs. Next is the construction mortgage. This is used when you are building a home from the ground up. Instead of receiving the full loan amount upfront, the lender releases the funds in stages, often called draws. These may include the foundation stage, framing stage, and final completion stage. During construction, you typically make interest-only payments. Construction mortgage involves more documentation and inspection compared to traditional mortgages. Let's talk about second mortgage and the LTVs, how you can get the second mortgage. Let's assume your home value is 1 million. From 1 million, lenders can lend up to 80% loan to value. Now let's say your first mortgage is 600,000 and you can get up to 800,000. What I mean by that is, let's say your first mortgage is 600,000 and the lenders can lend you up to 800,000. That means you still have room for 200,000 to get it. Now, let's say, for example, let's say something happens, right? Life is uncertain. Something happens. You lost your job. Your credit cards are filled up to 100,000 and the bank, and you don't want to break your first mortgage because your first mortgage is already at the lowest rate, which were a few years back. Let's say your first mortgage is at 1.5% still, and you need some money out of your equity. Now, the 200,000 that you have, you want to pay off your debts. For example, you have $100,000 in your credit card and you want to pay off those $100,000. You can get another second mortgage to pay off and consolidate your debts, that 100,000 that you have, and you may also get another 50,000 on top of it. Maybe you need some cash in hand. So in this case, second mortgage is very helpful. Now, the myth is that because it is with the private lender, you are doing the second mortgage because maybe you have bad credit score. Once your credit score is really bad, you only have choice for very less lenders. Let's say you go to the private lender, and the myth is the private lender charges very high amount, which in this market right now, which is very competitive, the private mortgage rates are very low. They are going towards 4.99%. Yes, you heard it right, 4.99%. And that solves a problem. And at the same time, private mortgage is a short-term solution. Let's say you took 1 year private mortgage, which is second private, and you take 100,000 from them, or maybe 150,000 to pay off your credit cards and all your debts so that your credit score starts going up. Once your credit scores start going up, you can easily move to your A or B lender if you have good income. So this is where the plan comes. So it's a complete plan that you have to work with your broker to get the second mortgage. But this is not uncommon. This is very common to get the second mortgage, consolidate your debts. Some people, I get so many calls, they don't even know about second mortgage. And I feel like it's the broker who needs to explain their clients that what second mortgage is. There are also specialty mortgages type you may hear about, including cashback mortgages, newcomer mortgages for recent immigrants, or investment property mortgages. Bridge financing for buying before selling, portable mortgages that allow you to transfer your mortgage to a new property, and assumable mortgages, where a buyer can take over the seller's mortgage under certain conditions. Each of these is designed for a specific situation. So, how do you choose the right mortgage? The best mortgage is not just about the lowest rate. It depends on your income stability, risk tolerance, long-term plans, whether the property is primary residence or investment, and how long you plan to stay in the home. A small rate differences matter far less than choosing the wrong structure for your financial strategy. If you found this helpful, subscribe for more mortgage education. If you're planning to buy and want help understanding which mortgage structure makes sense for you, leave your questions in the comment. The bank offers you a mortgage. Strategy puts you ahead. Thank you for watching.